morning everybody, and in this video I want to explain how to generate income from an arbitrage trade where you actually have no risk if you would do it the proper way and if you take care of one facet, which I'm going to mention later. So the idea is to profit from skew volatility and sometimes from raw. However, interest rates are zero, so raw won't play a big role here. So what is skew? Maybe to simplified, skew describes a difference in implied volatility, and we try to profit from a disparity now of premium between calls and puts. Again, raw is not so important for us. So how are we going to do this? We need to own 100 shares of the underlying, so we're going to be long, and we need to write a call option, and we need to buy a protective put at the same strike price. It can vary it a little bit, but that's a basic concept. And we are going to do this with leaps, where this imbalance would come the best into effect. So basically, in order that this idea would work, we need to find markets where there's a high demand for calls, so that we collect more premium from the written call than how much we paid for the long put. So we need markets where there is a high demand for protection of upside moves, and you can find this usually in the commodity markets. And then you also understand with which underlyings we are going to do this, and those are the most liquid one and also the most expensive one, where the premium disparity comes more into effect, and this is GLD from my experience in FXE. I can tell you over many years of observing this that also during crash times this might work for major ETFs like the S&PY, even QQQ. Even during the Corona crash, single underlyings, you could observe that. But generally, the skew tends to be, now currently, the skew is very high, still in GLD, where I would like to show you this. And one more aspect I would like to mention, because some people might wonder, isn't there any exercise risk, for instance, with that written call? However, if we own the 100 shares, nothing's going to happen to us, and we can simply close the trade. So let me show you now how this trade setup would work. And first of all, we need to find a leap, and we'll take the longest leap. In this case, it will expire 2023, and we'll take the strike price now, which is slightly in the money, of 178. And we would want to buy the leap put, and we want to sell, in this case, at the same strike price, a leap call. Now, you can vary later with the strike prices. I just want to trade it now with one strike price in order for you to understand it better. But later you have a little bit of playground where you would want to choose your strike prices. However, I don't recommend actually with the put to go too high into the money. You would end up holding more cash for this trade setup. You want to get into the trade with an option which is about to expire, where we have the lowest risk or almost zero risk according to the market maker. If we will go now into the same strike price, we want to sell it so that at the end of the day we have 100 shares of the GLD ETF, which is totally hedged with that one put option, but we are also not able to make more since we have the short call. And now maybe this is important. You also have playground here. You could also still go like right close to the money, so at the money, where you could still collect some dollars. However, we want to do it the riskless way, and we would get into where the delta is already at 1, pricing in that there's almost no risk, and in this case we would have actually collected $208 risk-free with this overall setup. Another important aspect I would want to emphasize here, and this actually might be a reason why it not suits everyone, and this is the problem with taxation. Now, I'm not a tax advisor, and I don't know in which country you live and how your tax system works, but what I know is also from many countries where you actually have to pay taxes for those trades, and this is that a sold option is usually calculated or comes into account the year it was sold. But if you buy a option, it might get into the tax year the year it expires. So in this case, our put would be in the tax year 2023, which might make it a little bit complicated to take everything together with that trade setup. But again, this is what you have to find out for yourself if you're interested in that way of trade setup. So now I calculated how much would you have earned with if you would do this with $100,000, and after calculating it, it would earn around 0.5% annually, where I know there's much better ways of how to invest $100,000. But at the end, if someone would ask you, is there a risk-free way to make money in the stock market, the answer would be yes.